Bismillahirrahmanirrahim. This is the fourth video on cost volume profit. In the first video, we explained the concept of cost behavior analysis. We explained the distinction between variable and fixed cost. We explained the significance of the relevant range and the concept of mixed cost. Then in the second video, we solved exercises on concept of cost behavior analysis. In the third video, we explained the 5 components of cost volume profit analysis. We explained the concept of contribution margin. We explained the 3 ways to determine the break-even point and the formulas for determining sales required to earn target net income. And finally, we defined margin of safety. In this video, we will solve exercises related to cost volume profit analysis. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We hope this video helps ACCA, AICPA, CPA, and CMA aspirants. We also hope that this video helps fresh graduates who have joined the companies and want to refresh their learning of cost, volume, profit. So let us start with the exercise on cost, volume, profit analysis. And here we have the first one. All that blooms provides environmentally friendly lawn services for our homeowners. Its operating costs are as follows. We have depreciation, advertising, insurance, weed and feed material, direct labor, fuel. All that bloom charges 60 per treatment for the average single family lawn. These are the instructions. Determine the company's break-even point in number of lawn services serviced per month and dollars. So we start with the part A, and first of all we calculate the contribution margin per lawn. So that is selling price minus the variable cost. So these are the 3 variable cost and these are the 3 fixed cost. So that is 60 minus 12 plus 10 plus 2. So that is 60 minus 24. So that is equal to 36. And then we have the contribution margin ratio. And contribution margin ratio will be equal to the contribution margin per lawn, that is 36. Contribution margin per lawn divided by the selling price. So that is 36 divided by 60. That gives us 60%. So the contribution margin ratio is 60%. Now this means that 0.6 of each dollar sales is available to apply to fixed cost and to contribute to net income. Now the fixed cost is 1400 plus 200 plus 2000, that is 3600. The break-even point in terms of lawns is equal to the fixed cost divided by the contribution margin per lawn So the fixed cost is 3,600 divided by contribution margin per loan, that is 36, that gives us 100. Next, we calculate the break-even point in dollars. Now we have the break-even point in loans, that is 100, and the selling price is 60, so that is 6,000 per month. That means the company has to make a sales of 6,000 to reach a break-even. We can also calculate break-even in by having dividing our fixed cost by the contribution margin ratio. So fixed cost is 3,600 divided by the contribution margin ratio, that is 60. So again you see we have 6,000 per month. Okay, let us look into another exercise. And the Green Acres Inn is trying to determine its break-even point. The inn has 50 rooms that it rents at 60 a night. Operating costs are as follows. We have salaries, utilities, depreciation, maintenance, maid service, and other costs. So these are the fixed cost, these four items, and this is our variable cost. So determine the inn's break-even point in number of rented rooms per month and dollars. So let us start with the part A, and that is contribution margin per room again, that is selling price minus variable cost, that is 60 minus 60 minus variable cost, that is 11 plus 28. So the contribution margin per room is 21, and the contribution margin ratio is equal to the contribution margin per room divided by the selling price, that is 60, that gives us 35%. The fixed cost is the total of the four costs that are here, so that is 8,400, and then the break-even point in terms of rooms is equal to fixed cost, that is fixed cost divided by the contribution margin per room, and contribution margin per room is 21. Fixed cost is 8,400 divided by 21, that will give us 400. So break-even point in rooms is 400. Next, we calculate the break-even point in dollars. So break-even point in dollars will be break-even point in rooms, that is 400, times the selling price per room, that is 60, or the rent per room, that is 60. So that is equal to 24,000 per month. That means the company has to rent its rooms for a minimum of 24,000 to make a break even. We can again use the formula, that is fixed cost divided by contribution margin ratio, to calculate the break even in dollars. So fixed cost is 8,400 and contribution margin was 35%. So that is again equal to 24,000 per month, just to verify that our calculations are correct. Let us look into another illustration. Care cars provided shuttle services between four hotels near a medical center and an international airport. Care cars use two passenger vans to offer 12 round trips per day. A recent month's activity in the form of a cost volume profit income statement is given below. We have the fares revenue, 1,440 number of fares, that is equal to 36,000. We have the variable cost, and you know that sales minus variable cost give us the contribution margin, and when we subtract the fixed cost, we get the net income. So calculate the break-even point in dollars and number of fares, and then without calculations, determine the contribution margin at the break-even point. Okay, so let us start with part A. And once again, the contribution margin ratio, that is the contribution margin, that is 27,000, sales minus variable cost divided by total sales, that is 36,000. So that gives us 75%. So break even point in dollars will be equal to fixed cost divided by contribution margin ratio. So that is equal to fixed cost is 15,000 divided by contribution margin ratio 75%, that gives us 20,000. Then the round trip fare will be the total revenue 36,000 divided by the number of value of fares, that is 1,440, that gives us $25 each for. And then the break even point, as they are asking in fares, in terms of fares, that will be 20,000, the break even point in dollars, divided by the round trip fare, that is 25, thus that gives us 800 fares. Next, they ask without calculation, determine the contribution margin of the break even point. So you know that at the break even point, fixed cost and the contribution margins are equal. Let us look into another exercise. Cairns Company has the following information available for September 2014. We have the selling price, unit selling price, unit variable cost, we have the total fixed cost, and we have the total units sold. And they are asking us to compute the contribution margin per unit. So contribution margin per unit, part A, you know, is selling price minus variable cost, and the selling price is given to us as 400, variable cost is 275. So 400 minus 275 gives us 125. Next, they say prepare a cost volume profit income statement that shows both total and per unit amounts. Okay, we go to part B. So we have sales, and sales is for units sold is 600 times the unit selling price, that is 400, that gives us 240,000. And if we got, this is the in terms of total, and if we say per unit, the cost selling price is 400. Then we have the variable cost, and the variable cost per unit is 275, and the units sold are 600 times 275, that will give us 165,000, and the per unit variable cost is 275. So we have the contribution margin, that is 75,000, and here per unit it will be 125,000. And the net, we will subtract the fixed cost, that is 52,000, and that will give us a net income of 23,000. We go to C. compute Keynes break-even point in units. So we know that sales is equal to variable cost plus fixed cost in case if we have the in units. So the selling price per unit is 400. Suppose we are selling X number of units to have a break-even point. So variable cost will be 275 per unit times X plus the fixed cost, and that is 50,000. It do not change. So 400x minus 275x will give us 125x is equal to 52,000, or x is equal to 416 units. So the break-even point in units is 416 units. In part D, they say prepare a cost, volume, profit, income statement for the break-even point that shows both total and per unit. That means we have to prepare the income statement assuming the number of units sold is not 400 but the break-even unit, that is 416. So again we have sales 416 times the selling price, that is 400. So that gives us 166,400. So the per unit, it is, it is 400. And then we have the variable cost, and the variable cost will be it is going to be the number of units for break even times the variable cost per unit, that is 275. So that gives us 114,400, and per unit variable cost is 275. So the contribution margin is 52,000, and we already have the fixed cost, that is 52,000. So you can see that net income is 0. So the contribution margin will be 125. So you can see that if it is a break even, there will be no profit and no loss, and that's how we are going to prepare the income statement. Next we go to another exercise. Shingle Enterprise is considering manufacturing a new product. It projects the cost of rice. Company has a unit selling price of 520. Variable cost per unit is 286 and fixed cost is 163. Compute the break-even point in units using the mathematical equation. Okay, so we are going to calculate the break-even point in units. So break-even point in units will be the selling price 520, and we assume the number of units are X. So selling price minus the variable cost 286 times number of units X minus fixed cost, that is 163,800, is equal to 0. So when we solve for X, X will be equal to, or rather equal to 700 units. So we have to sell 700 units to get a break even. Then we go to part B, that is contribution margin per unit. Now contribution margin per unit is sales minus variable cost. So we have X again as our assumed value. So contribution margin is sales minus variable cost, and sales is 520. Sorry, let me put it like this. We have the fixed cost divided by the contribution margin per unit, and that is sales minus variable cost. So fixed cost is 163 800 divided by sales minus variable cost, that is 520 minus 286. So 163 800 divided by 234, that gives us 700 units. So we can calculate the break-even point in units either by a mathematical formula, or we can even use the contribution margin concept to calculate the break-even point in units. Let us look into another exercise. A corn company has the total variable cost of 180 and the fixed cost of 170 and the revenue of 300. Compute the required sales in dollars to break even. So once again we will use the contribution margin ratio. In this case, now contribution margin in this case is sales minus variable cost, and sales is 300,000 minus variable cost 180,000, and we divide this by the total revenue, that is 300,000. So that gives us 40%. So contribution margin ratio is 40%, and we need the required sales in dollars. That will be equal to total fixed cost divided by the contribution margin ratio. So 170 divided by 40%, that is equal to 425,000. So the required sales in terms of dollars is 425,000. Let us look into another exercise. And Presto company makes radios that sell for 30 each. For the coming year, the management expect fixed cost to total 220,000 and variable cost to be 18 per unit. Compute the break-even point in dollars using the contribution margin ratio. So we start with part A, and contribution margin per unit. This will be unit selling price minus unit variable cost. So selling price is 30 and the variable cost is 18. So that gives us 12. Next, we will calculate the contribution margin ratio, and that is contribution margin per unit divided by the unit selling price. We have just now calculated the contribution margin per unit as 12 and unit selling price is 30. So that gives us 40%. So contribution margin ratio is 40%. Next, we will calculate the break-even point in dollars. So that will be fixed cost divided by the contribution margin ratio. So fixed cost is 220 divided by contribution margin ratio, that is 40%. So that is equal to 550,000. So to break even, they have to make a sales of $550,000. Then they ask us to compute the margin of safety ratio. So margin of safety, that is equal to actual sales minus break-even sales divided by actual sales. So actual sales is given to us as 800,000 minus break-even sales is 550,000 divided by actual sales, that is 800,000. So this will be equal to 31.25. So the margin of safety is 31.25%. Then we go to part C, and in part C they say compute the sales dollars required to earn a net income of 140,000. So we go to part C. Now we need a net income of 140,000. That means sales minus variable cost minus fixed cost must be equal to 140,000. So 140,000 is equal to selling price we have as 30, and we assume that we are selling X number of units to make a profit of 140,000. So that is 30x minus variable cost per unit times the number of units as X plus the fixed cost, and the fixed cost is 220,000. So 140 plus, sorry, so 30x minus 18x, that will give us 12x plus 220,000 is equal to 140,000. Minus. So we are going to have 220,000. So 12x is equal to 140,000 plus 220,000. So x is equal to 30,000 units. That is 360 divided by 12 will give you 30,000. And if we want to convert them in terms of dollars, so obviously 30,000 times the selling price, that is 30, so that will make $900,000. So if we want to make a profit of 140,000, we must say make a sales of 900,000. Let us look into another exercise now. Naylor company has 210,000 of net income in 2013 when the selling price was 150. The variable cost per unit were 90 and the fixed costs were 570. Management expect per unit data and total fixed cost to remain the same. In 2014, the president of Naylor Company is under pressure from stockholders to increase the net income by 52,000. Compute the number of units sold in 2013. So to sell the number of units sold in 2013 will be fixed cost plus the net income divided by selling price minus variable cost, and fixed cost is 570,000 plus net income 210,000 divided by 150 minus 90, that is equal to 13,000 units. We go to part B. Compute the number of units that have to be sold in 2014 to reach the stockholders' desired profit level. Okay, so units needed in 2014 will be the fixed cost plus the net income, including the expected net income of the stockholders, divided by selling price minus variable cost. So fixed cost is 570 plus net income now will be 210,000 plus the desired profit of 52. So 210 plus 52 will be 262,000 plus 262,000 divided by selling price minus variable cost. So if we solve it, this will be 13,867 units. We go to number C now and assume that Naylor Company sells the same number of units in 2014 as it did in 2013. What would the selling price have to be in order to reach the stockholders' desired profit level? So again we have 570,000 as our fixed cost, and the total profit should be 262 because we have to add the desired profit of the stockholders as well. Now we do not know the selling price, so we take it as X minus 90, and this must be equal to the number of units, that is 13,000 units, because this is for the year 2013. So 13,000 units. So if we now solve for X, X will be equal to 154. So the new selling price should be 154 if we want to add up the expected profit of the stockholders, that is 52,000. Let us look into another illustration now or exercise. For Flying Company, a variable cost are 70% of sales and fixed cost are 195. Management's net income goal is 75,000. Compute the required sales in dollars needed to achieve management's target net income of 75,000. So if variable cost is 70% of sales, so the contribution margin ratio will be 1 minus 70% divided by 1, that will give us 0.3. So the contribution margin is 0.3, and they are asking us to have a required sales to make a profit of 75,000. So this will be equal to fixed cost plus target net income divided by contribution margin ratio. So fixed cost is 195,000. Target net income is 75,000 and the contribution margin ratio is 0.3. So this is equal to 900,000. So the company must sell in dollars. $900,000 of sale has to be done to make a profit of 75,000. Let us look into another exercise. Dines Corporation has fixed cost of 480,000. It has a unit selling price of 6, unit variable cost of 4.4, and target net income of 1,500,000. Compute the required sales in units to achieve its target net income. Now once again, the contribution margin, that is sales minus variable cost, that is 6 minus 4.4, that will give us 1.6, and the required sales in units, that will be equal to fixed cost plus net income divided by the contribution margin per unit. So fixed cost is 480,000 and the net income is 1,500,000 divided by contribution margin per unit, that is 1.6. So that is 1,237,500. So that's how we calculate, and we move on to another exercise now. For Stevens Company, actual sales are 1 million and break-even sales are 840,000. So compute the margin of safety in dollars and margin of safety ratio. Now remember that margin of safety is the difference between actual or expected sales and sales at break-even point. So margin of safety is equal to, once again, sales minus break-even point. So sales is 1 million minus break-even point 840,000. So that gives us 160,000. Next we calculate the margin of safety, and margin of safety is margin of safety in dollars divided by actual or expected sales. So that will give us the margin of safety ratio. So we have the margin of safety in dollars, and that is 160,000 divided by actual or expected sales, that is 1 million, and that is equal to 16%. So margin of safety is 16%. Let us look into one more exercise, and here we have Glacial Company estimates that variable cost will be 62.5% of sales and fixed cost will total 600,000. The selling price of the product is $4. Prepare a cost volume profit graph assuming maximum sales of 3,200,000. Note that that 400,000 increments for sales and cost and 100,000 increments for units. So prepare a cost, so compute the break-even point in units and dollars and compute the margin of safety in dollars and as a ratio, assuming actual sales are 2 million. So again we have the number of units over here and we have the dollar sales over here, and The fixed cost remains fixed, it do not change. This is our sales graph, and this is where our total cost line is going to intersect, and the break even point is $1,600 or $1,600,000 or 400,000 units, as we would like to say. We move on to part B, and in part B they say compute the break even point in units. So break even point in units will be the total that will be selling price is 4, so 4 times x is equal to the variable cost, and the variable cost is 62.5% of 4, that is selling price. So this will be equal to 2.50, and we take it as x plus the fixed cost, that is 600,000. So the number of units to be sold will be 400,000 units to have a break even. Now if we want to calculate the break even in dollars, this is part 1, and we go to part 2, break even in dollars. So x is equal to 0.625, 62.5% plus the fixed cost times x. So x minus 0.0625x is equal to 600,000, or x is equal to, or what, 0.375x, 600,000. So x is equal to 600,000 divided by 0.375. So x is equal to 1,600,000. 600,000 divided by 0.375, 1,600,000. Or next we go to part C, and in part C they say compute the margin of safety in dollars. So margin of safety in dollars, that will be equal to 200,000, sorry, 2 million minus 1,600,000 that we have calculated just now, that will be equal to 400,000. In part D they say as a ratio, assuming okay, in dollars and as a ratio. So if we calculate margin of safety ratio, so this will be equal to margin of safety in dollars, that is equal to 400,000 divided by the assumed actual sales, that is 2 million. So this will be equal to 20%. So this completes our discussion on exercises on cost, volume, profit, and I hope that this is going to help you in clarifying the concept. And if you have any question related to this video, please share it in the comment box or send me by email, and inshallah I will reply you back. Thank you so much and happy learning.